Hey everyone, Ryan Shepard, partner with Knight Riley Shepard CPAs in Fairfield, Connecticut. Today I want to talk to you about the Biden administration revenue policies for fiscal year 2022. Now, with any new presidency, inevitably what happens is they have their own agenda, their own revenue policies that they want to get across. And when you take a look at some of the areas that this particular administration is proposing, I wanted to go through some of the highlights of that show some areas in which they have their attention on. So I'm not going to go through everything, but I am going to point out some highlights that hopefully are of interest to you. The first one that you hear about a lot is the corporate tax increase. So as part of Trump tax reform, the tax rate went from 35% to 21% for corporations. Well, under the Biden administration, they want to push that from 21% to 28%. So a kickback up in the area of corporate tax. That may affect future dividend payouts for individuals and other matters. And it also affects competitiveness when you're competing with other corporations on the world stage. So, stay tuned for that. There could be some changes there. Marginal tax rate for high earners. So what they want to do here is take the top tax rate, which right now is 37%, and raise it to 39.6, which is Obama era top marginal rates. So that's an increase of nearly 3% on those households making over 500,000 at the top rate. So that's sort of that's one of the easier ones they can actually get implemented. So I do expect that to possibly happen. Long-term capital gains. So this is a relatively large proposed increase. Now I want to be clear about something though. Any of these increases, remember, these are all proposed. So a lot of this still has to get through Congress and still has to be approved. They do control all three houses of Congress, however, so they do have a little bit of a leg up in getting a lot of these things implemented. Nonetheless, the Senate is pretty narrowly divided, so remains to be seen. But just stay tuned. This is not law as of now. These are just proposed. The long-term capital gains and qualified dividends, they want to tax that at ordinary rates. So right now, as of today, qualified dividends, which are usually like U.S. company type dividends, they are taxed at what's called preferential rates. So for many people, that will range anywhere between 15% and 23%. Now, they effectively want to make that rate now 37 or 39.6%. So as you can see, you're going from potentially 15% to 39.6 or even 23.8% to 39.6. So either way you slice it, that's a substantial increase in qualified dividends. So that may change the way you invest, or may change the way your asset manager is where you're putting your money. Long-term capital gains. So for the longest time, long-term capital gains, they are defined as stocks that you hold for longer than a year. And there's always been preferential rates on that. Same thing. Those rates generally range between 15 and 23% on stocks that you hold for longer than a year. Well, if your income exceeds $1 million, they want to now tax that also at 39.6. So no preference on long-term capital gain rates in that area. Furthermore, they want to also make that particular provision retroactive to April of 2021. So that's not good. Don't like that one, but nonetheless, that's what they're looking for in the proposal. So a couple of relatively large tax increases so far. Here's a big one that's going to create some controversy, and that's related to the estate tax. So currently, when someone passes away and they hold investments, well, that stock gets what's called a step up in basis for the beneficiaries, which means whatever the fair market value of that stock was at the date of death, the person receiving it, they then get whatever the fair market value of the stock was at date of death. That's going to be their basis. So when they sell it, that's their kind of starting point, difference between gain or loss, but that's their starting point. What the Biden administration wants to do is actually trigger a deemed sale at the date of death and tax those capital gains at the date of death. So if I bought a stock 10 years ago for $100 and now I pass away and the stock is worth $250, let's say, they want to trigger a capital gains tax at the date of death on that $150, even if it was never sold. I just happened to pass away, and that's the date that they chose to trigger the tax. So not great either. That's going to be pretty controversial. I don't know what's going to happen with that one, but it is something that they're pushing for. And as part of that, you're not going to get a step up in basis either. So the basis that I talked about a couple of minutes ago, that's not going to happen, at least under the current proposal. So another proposal that they want to do, it feels like one after another, is what's called net investment income tax on what's called non-passive income. What the net investment income tax is basically Obamacare tax. It's a 3.8% surcharge that, as part of Obamacare, they effectively taxed you on investment income, interest, dividends, capital gains. If you're over a certain income limit, they're tacking on another 3.8%. But it was never intended to apply to regular earnings, like your earnings for a job, or your self-employment earnings, or let's say you own a business, those earnings. Like, it was only meant for passive income, interest, dividends, that kind of thing. Well, they want to now assess it on trade or business income that may not be subject to employment taxes. So that's a big shift. So now they're talking about adding that additional 3.8% on non-passive income, if you will. So earnings from employment, not employment necessarily, but earnings from your own business, that kind of thing. They want to slap on another 3.8% there too. One other thing of just important to note about their provision as well is they want to change the limitation of like-kind exchanges. Now, currently, like-kind exchanges have already been restricted. Now, what that means is if I own a piece of property and I have a gain on that property, but I haven't sold it yet, but I have a built-in gain, and now I want to sell it and buy a new piece of property and roll those gains into the new property. Now, this would be investment property, not a primary residence, but I can defer that gain under what's called like-kind exchange rules into the new property, at least until I sell the new property. Well, this provision, they want to actually limit that even further. So they want to limit that to an aggregate deferral gain of $500,000 per taxpayer. That used to be, like-kind exchanges used to be, you could do it equipment for equipment, land for land, residential or real estate for real estate, that kind of thing. And so it's further been limited, it's further been refined, and now they want to limit the amount. So currently they're talking about $500,000 per taxpayer, and that's what they're talking about. So as of now, we don't know what's going to happen. It still has to go through Congress. There is a lot of pushback in some of these areas. We'll see what happens, but we'll continue to keep you informed throughout the way. Thanks.